Is real estate still the safest way to build wealth in 2025? Why are investors both buying in and pulling out at the same time? And could the next big opportunity, or risk, be hiding in plain sight? Before we go deeper, this is Financially Well. Real estate has historically been a foundation of generational wealth, tangible, inflation-resistant, and psychologically reassuring. Yet, the current landscape is far from predictable. Mortgage rates remain elevated compared to pre-2022 lows. Inventory varies wildly from low-supply suburbs to oversaturated urban condos. Some markets are in full swing, while others are flatlining or declining. Result: the legendary stability of real estate is under scrutiny, but opportunity hasn't disappeared. It's merely transformed. Here's the new reality. Institutional investors, particularly large funds and REITs, are actively buying single-family homes, especially in high-growth metro areas, turning them into long-term rentals. This shift has turned what used to be a predominantly owner-occupied asset class into one increasingly driven by rental yields and scalability. As demand for rentals climbs, especially in Sunbelt and suburban cities, cash flow becomes far more important than anticipated future appreciation. Investors who focus solely on price trends without understanding income potential risk being blindsided. Meanwhile, many traditional owner-buyers are retreating from markets where affordability has collapsed. With local governments implementing stricter rent control laws and zoning restrictions, the dynamics of supply and regulation have changed the playing field. Buying for appreciation alone is no longer reliable. You either choose an undervalued emerging market, a growing secondary city, or a property class with untapped income potential, like small multifamily units, mixed-use buildings, or properties convertible to short-term rentals. To succeed in 2025, investors need to think strategically. Dynamic markets, adaptive models, and multiple pathways to returns. For instance, house hacking, living in part of a property while renting the rest, can offset financing and yield early cash flow, especially if rates are high. Similarly, partnering to convert properties into co-living or flexible rental units can deliver significantly stronger yield than traditional single-family rentals. Alternative entry strategies also matter. REITs and real estate crowdfunding platforms provide exposure to property markets without demanding full ownership or high upfront capital. For those hesitant to commit to complex management responsibilities, these models offer access to commercial real estate, single-family rentals, or development projects with lower capital barriers and more diversification, though at the cost of control. Then there's regional demand, shifts in remote Phoenix and Charlotte, where population, jobs, and housing demand continue rising. In contrast, major coastal cities, especially those with restrictive supply laws, face challenges in affordability and stagnating appreciation. Local knowledge is now a prerequisite. Selecting a hyperlocal micromarket within a broader metro area could determine whether returns are meaningful or marginal. Policy changes mean opportunity and risk accelerate faster. States tightening housing regulations or imposing property taxes might create entry points in undervalued areas, while short-term rental bans can derail strategies based on Airbnb or VRBO income. Investors must now analyze legislation, zoning, and enforcement trends as part of basic market due diligence, especially for vacation or mixed-use properties. Financial structure also matters more. With rates high, the terms of a loan, down payment size, amortization period, adjustable versus fixed rates, have a larger impact on viability. A property that seemed promising at a 3% rate might suddenly look less profitable at 6.5%. Sensitivity to financing and operating expenses is crucial. A healthy investment today must handle rising rates without collapsing. Looking forward, demographics suggest that real estate remains one of the few scalable paths to build long-term wealth, if approached wisely. Trends like an aging boomer population seeking smaller homes, massive immigration, boosting demand in some regions, and continued labor shifts to the Sun Belt create structural tailwinds. Investor capital, in turn, amplifies the gap between high-demand, undervalued regions and overbuilt, overheated markets. There is also a subtle shift occurring in how real estate investors think about liquidity. In the past, property was seen as a long-term hold, fixed, physical, relatively illiquid. Now, thanks to tokenization, real estate portfolios are beginning to mimic public market liquidity. Through blockchain and digital asset infrastructure, some platforms now offer fractionalized ownership where shares of real estate can be bought or sold instantly. While still nascent, this trend may reshape investor psychology, allowing real estate to function more like a stock, without entirely abandoning its physical asset status. Meanwhile, construction trends are influencing investor behavior. Modular housing, 3D printing, and prefabricated building components are cutting costs in areas where zoning allows for flexibility. Investors willing to explore these options in states with high housing demand but tight budgets, like Arizona, Utah, and parts of the Midwest, can leverage faster build times and lower per-unit costs to maximize returns. But these models require a firm grip on both logistics and regulation. Spreadsheet can fall apart if local permits don't align. Investors are factoring in climate maps and insurance risk into decisions more than ever before. Properties in Florida, California, and coastal zones may carry not just higher premiums, but also long-term risk of value erosion. Conversely, regions like the Appalachian Corridor, parts of the Midwest, or inland Texas are becoming climate havens that may rise in demand due to perceived safety from major events. Factoring environmental risk into a long-term buy-and-hold strategy is no longer optional. It's a core part of value preservation. The transformation also touches how tenants interact with properties. Smart home technology, energy efficiency, and even wellness-focused design are no longer luxury upgrades. They're fast becoming tenant expectations. Investors in rental property who don't adapt to these shifts may find themselves with higher vacancy or tenant turnover. Properties equipped with solar panels, app-based access, touchless entry, and air purification systems. So yes, real estate remains a powerful path to wealth in 2025, but it's no longer passive. Investors must be strategic, hands-on, and ready to pivot quickly. Market dynamics are evolving, and success depends on your ability to evolve with them. Gone are the days of simply buying and waiting. Today's winners are studying trends, optimizing taxes, building relationships with tenants, and selecting cities with precision. Flexibility, innovation, and operational excellence now define the smartest investors. If you're ready to think beyond outdated models and take real estate seriously in 2025, the opportunity is still massive, but only for those who do the work. Subscribe for more strategic, grounded perspectives, only on Financially Well.